Hi everyone, and welcome back to the Independent Dollar. Today we're taking a closer look at RSPs and a few reasons you should stop using them. If you're like us, then you probably grew up being told you need to start saving as young as possible, and when you do, all of your savings should be going into an RSP account, that magical retirement account that you need to have if you eventually want to be able to retire. So let's jump right into it and see a few examples of when RSPs can actually work against you. First up is if you have a low income. I know it can be exciting to purchase your very first investment and start to see those retirement savings grow, but if you're just starting off in your career or you have a modest income working full-time, you really should consider avoiding the RSP. RSPs are all about the tax savings that they offer us. RSPs have been around since the late 1950s, but since then, other options have been created that might be a bit more suitable, like the tax-free savings account, for example, and in some cases, even just a normal investment account might be a better fit than an RSP. Even though non-registered investment accounts aren't tax-free, they do still allow you to benefit from tax savings in other ways based on the type of investments that you buy. For example, only 50% of your capital gains are taxable. You can offset your capital gains with capital losses, and dividend income will benefit from special tax credits in non-registered accounts. Depending on how much dividend income you're actually receiving, the taxes payable in some cases can be close to zero, compared to the RSP where every single dollar you withdraw from the account is fully taxable income. To show you a quick example of this, let's say we withdrew $30,000 in dividends from an RSP. Your taxes payable on that would be close to $4,000. In comparison to a non-registered account, when we factor in all those dividend tax credits in Canada, your taxes payable on that same $30,000 would be about $150. In a tax-free savings account, if you're investing in Canadian dividend-paying companies, the taxes would be zero. Another reason to avoid RSPs is you're paying into a pension where you work. One of our largest workforces here in Canada is our public sector, and among some of the benefits that you get working for the government, one of the most desired is their pension. Unfortunately though, I've met many individuals who were retired with workplace pensions that ended up realizing that the RSP was actually the wrong choice for them after all these years. Once we factored in their monthly pension, how much they'd be getting from CPP and OAS, and then finally those RSP accounts, they realized they're paying more in income tax now in retirement than when they were actually working. While having too high of a retirement income is of course a problem many people would love to have, it meant in their case, not only did it push them into a higher tax bracket, but it also meant the clawback of other benefits that they were expecting to receive. So if you are paying into a workplace pension, run the numbers ahead of time or work with a financial planner to see if the RSPs still make sense for you. If you plan on leaving the country, RSPs may not be the right choice for you. If you're only going to be in Canada for a very short period of time, you have plans of retiring outside of the country, or maybe you want to relocate abroad in the near future, you may want to consider avoiding RSPs altogether. With RSPs, any income you withdraw from the account is considered taxable income. This is important to understand because once you leave the country, depending on where you go, they may or may not have a tax treaty in place with Canada. Tax treaties are in place between two countries to help individuals avoid double taxation. Meaning, if you pay tax on your income in one country, then you won't have to pay tax again on that same income in the country that you move to. As a non-resident, once you start withdrawing money from your RSP, Canada will automatically withhold 25% of whatever you withdraw for taxes. This withholding tax essentially eliminates the need for you to file a Canadian income tax return. You can then claim that withholding tax as a credit on your tax return in the country that you now live in, if they have a tax treaty in place. However, if there isn't a tax treaty in place, you might be forced to pay tax on that income twice. On top of that, not all countries will recognize the tax deferral or tax-free status that Canada gives you on things like your RSP or your tax-free savings account. In the United States, for example, your tax-free savings account would be considered taxable income, even if it remains in Canada and you're not taking money out of the account. So if you plan on moving, you should be seeking advice from a cross-border accountant before moving forward with any of your investment accounts. Another downside to holding an RSP once you leave the country is that not all banks and investment companies will actually allow you to maintain it or even transact on the account once you become a non-resident, and that decision is at their discretion. So you also need to ensure you contact the brokerage or investment company where those accounts are held to confirm whether or not they'll actually allow you to maintain it once you leave Canada. Another reason to avoid RSPs is that your RRSP accounts are already substantial in size. While RRSPs can provide substantial tax savings under the right conditions, eventually you will be forced to start withdrawing from them once you convert them into a RRIF, or once you eventually die. The amount you must withdraw from your RRIF account every year is determined by CRA, and it's based on a percentage of the balance. So the larger the account, the larger your annual withdrawal, which is then added to your taxable income. Not only will this increase the amount of income tax you need to pay every year, it could potentially put you into a higher tax bracket than when you were actually working, and even cause a clawback of income-tested benefits that you were expecting to receive in retirement. When you die, if you're married, the account is then transferred to your spouse tax-free. However, once your surviving spouse dies, or if you die without a spouse, whatever is left in the RRSP account is now liquidated and the entire remaining balance is added to the taxable income for that year. So for those with large RRSP accounts, it could mean an income in the hundreds of thousands of dollars at death, leaving your estate with a very sizable tax bill and less money to your beneficiaries. When deciding whether the RRSP is right for you, keep in mind that it's not just about saving for your retirement. It's about creating tax-efficient wealth and cash flow now and in the future. And as we showed you, sometimes an RRSP account can actually work against you. If you're still trying to figure out whether the RRSP or TFSA is best, we have a really great video with a few examples of when to use each of these accounts. Thank you so much for watching, and we'll see you back here next week.